Hey guys, welcome back to the channel. In this video, I'm going to talk about how to analyze an option chain properly. Even if you are someone who is new to the world of options trading, or if you are having difficulty in understanding many concepts associated with options, or even if you are confused for that matter, don't worry because this video will clear most of your doubts and queries. Understanding how to analyze and interpret an option chain data can help you better your chances when it comes to identifying trade opportunities and also to take only convincing trades that have a higher probability of success. So with that idea in mind, this video will cover the following topics. First, we will look at a typical option chain, understand every important section of it, and learn about the important jargons and how they are being represented within an option chain. Then, we will have a detailed discussion about open interest and change in open interest. We will learn how to interpret and use the open interest data to read the market in a precise manner. So watch the video till the end and make sure to like and subscribe to the channel so that you won't miss out on any upcoming videos. So without wasting any time, let's get started. You can get the option chain from different sources. You can get it from the NSE website or you can access them from Opstra or Sensible. But let me make use of the option chain from NSE website for this video. Before going any further, let me clarify some basic concepts associated with options trading. I hope you are aware of what the concept of option contract is. Now, the contract is also called as a derivative just because the contract itself has no value. It derives its value from an underlying, which may be a stock or an index. For example, a Reliance option contract gets its value from the underlying Reliance stock. So any change in the value of the stock is associated with a change in the options contract. So in the option chain, you have the option to select the desired underlying. It can be a particular stock or an index. Now in the indices section, there are 4 available options to choose from, of which only Nifty and Bank Nifty have the ample liquidity. Next, you will get the option to select the expiry date. Similar to a food product that has an expiry date, which is the last day till which it can be consumed safely and after which it has to be scrapped. Similarly, an option contract has a far month, near month and current month expiry. Here you can see 3 different option contracts which expire on 3 different months and all of them expire on the last Thursday of every month. Now when it comes to index options, there are weekly expiries also available along with the monthly expiries. Same with monthly expiries, the weekly contracts also expire every Thursday. So different expiries come with different premiums and totally different expectations about the market. Now the next component is the strike price. In order to understand the strike price, let us shed some light on spot price first. The spot price is the current market price of the underlying, which is considered as a reference while selecting a particular strike price. For example, Reliance stock is trading at the current market price of 2,400 rupees in the spot market. This is the spot price or the underlying price for Reliance. You can see the spot price just below the contract symbol in the option chain. Now on the other hand, the strike price is an anchor price or the price that you expect Reliance to be trading at the end of the day or at the end of an expiry and at which both option buyer and option seller enter into an agreement. It is like a reference point for many other calculations like the break-even point, intrinsic value of option, etc. So there are a lot of strike prices available to choose from and we will get to that in a moment. Now coming to the main portion of an option chain, you can see that there are 2 sections. The left side is the call section and the right side is the put section. Now let us briefly understand what they imply. Call options gives the buyer of an option the opportunity to benefit from increasing prices of stock or an index. So when you have a bullish sentiment in the market and you expect the prices to move higher, then you can buy a call option contract. On the other hand, if you expect the market to move lower or expect the prices to fall, then you can think of selling a call option. Now when it comes to a put option, you buy a put option when your sentiment is bearish and you expect the market to crash lower. On the other hand, you sell a put option when you have a fairly bullish or neutral view of the market. If we look closely, we can observe colored or highlighted sections and plain sections in an option chain. To understand this, we need to learn about the moneyness of options. Now, moneyness of option is a classification method that classifies each option strike based on how much money a trader is likely to make if he were to exercise his option contract today. Now, there are three broad classifications: in the money options, at the money options, and out of the money options. But for practical purposes, we can expand this classification to include two more types of options, that is, deep in the money and deep out of the money options. Let us make a note of each one. A call option is said to be in the money if the strike price is less than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,360 and 2,340, etc., which are lesser than the spot price, are said to be in the money strikes. On the other hand, a put option is said to be in the money if the strike price is more than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,420, 2,440, etc., which are greater than the spot price, are said to be in the money strikes. Now, the in the money strikes are usually highlighted. In this particular option chain, the in the money strikes are indicated in yellow. A call option is said to be at the money if the strike price is almost equal to the current spot price of the security. So, for instance, the Reliance is now trading at 2,395. Then the option strike of 2,400, which is very close to the spot price, is said to be an at the money strike. Similar is the case for put options. A put option is said to be at the money if the strike price is almost equal to the current spot price of the security. The ATM strikes are usually represented at the center of the option chain, but the strike changes as and when the underlying price or the spot price changes. A call option is said to be out of the money if the strike price is more than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,420, 2,460, etc., which are higher than the spot price, are said to be OTM strikes. A put option is said to be out of the money if the strike price is less than the current spot price of the security. For example, Reliance, which is trading at 2,390 rupees, the option strikes like 2,360, 2,340, etc., which are lesser than the spot price, are said to be out of the money strikes. The out of the money strikes are not highlighted and are represented in plain or white colors. Now, what are deep ITM and deep OTM strikes? The strikes which are too far away from ATM options are called as deep ITM and deep OTM strikes. Most often these strikes are illiquid and are less often traded. Moving on, beside the strike price, we can see bid and ask quantity and bid and ask prices. Now, bid and ask are market terms which represents demand and supply for a particular stock. The bid price represents the highest price that someone is willing to pay for a share. The ask price, however, is the lowest price where someone is willing to sell a share. Now, the difference between the bid and ask is called as a spread. Now, the bid size represents the quantity of a security that the investors are willing to purchase at a specified bid price. In a similar manner, the ask quantity represents the total number of sellers in a particular strike who are willing to sell at the specified ask price. So, in short, the bid and ask data helps you visualize the available prices and quantities for a particular strike. Now, beside the bid and ask are the LTP or the last traded price and the changes in LTP. So, LTP is actually the premium of the option at a specified strike price, and the change in LTP is the percentage change in premium compared to the previous day's closing price. Now, this helps to decide if the options are priced cheap or expensive. Now, there are several factors that decides the option pricing, but LTP can give you a bird's eye view. We will talk about option pricing in a different video, but for this video, let us limit our discussion to option chain. The next element is volume, which you may all be familiar with. So in simple words, volume refers to the number of contracts that are traded in a given period of time. I have already made a video on market volumes from a price action perspective. So if you want, you can check that out. The next component is IV, or the implied volatility, which itself is a broad topic. So we will discuss it in an upcoming video. Right. The final two elements are open interest and change in open interest. Now, open interest denotes the number of contracts that are active or which are not settled. Now, both volume and open interest are two key technical metrics that helps describe the liquidity and activity of options and future contracts. In terms of options, we are more interested in analyzing the open interest because it is of great use to us. But before all that, let me tell you with whose point of view you should look at an option chain. To be frank, writers or sellers of options are more important, and we should view the option data from the perspective of a seller. Now, there are many reasons for this statement. First of all, it takes conviction to sell, as there is unlimited risk associated with selling options, and therefore more money is required. Secondly, sellers are usually someone with bulk amounts of money, like big institutions or smart money, and option buyers are usually the retail traders, as it is convenient to do option buying with less capital. So in short, going by the idea that institutions are usually right, we view data from the perspective of an institution. With that idea in mind, let us focus on open interest. The first question that has to be answered is, how does changes in option interest occurs? We all know how volume data is calculated, but the open interest calculation is a bit different but interesting to learn. If both participants in a trade are initiating a new position, the open interest will increase. And if both the participants are liquidating an already existing open position, then the open interest will decline. However, if one participant is initiating a trade while the other is liquidating or squaring off an old trade, then the open interest will remain unchanged. So let us understand this with an example. Let's say person A and person B are trading the same option contract. So if A buys one contract to enter a long trade, the open interest increases by 1. Now the person B also goes long and buys 6 contracts, thereby increasing the open interest to 7. Now if another person C decides to short the market and sell 3 option contracts, then the open interest again increases to 10. The open interest would remain at 10 until the traders exit their positions, at which point the open interest declines. For example, the open interest declines to 9 when person A sells his one contract. Now when the person C decides to exit his position, he buys back his 3 contracts and brings the open interest down to 6. At this point, until the person B decides to sell her 6 contracts, the open interest will remain constant at 6. So even though open interest and volume are related concepts, one key difference is that volume counts all the contracts that have been traded, while open interest is the total of all the contracts that remain open in the market. Now keep in mind that we are talking about the number of contracts and not the number of shares. Now I want to talk about a common misconception about open interest. I've seen many people make this assumption that when prices are rising, they assume that more long positions are being created than short positions. But the fact is that the longs will always be equal to the shorts. But it is just that the longs are dominating the shorts in the transaction, and that is the reason why the prices are rising. Now you may ask me, if the number of shares bought is always equal to the number of shares sold, then how does the price rises or fall? Now the simple answer is buying pressure or selling pressure. So if buyers of a contract are dominating the sellers and they are willing to buy at higher prices, the prices will eventually rise. And if the sellers are dominating the buyers by selling at even lower prices, the prices will fall as a result. But buyers will always be equal to the sellers, because for a transaction to happen, there is always a seller for every buyer. So if the open interest is rising, it means new contracts are being added. But since the prices are rising with it, it means that the longs are dominating the shorts in the transaction. If the open interest is rising but the prices are falling, this means that more contracts are being added, but this time the shorts are dominating the longs in the transaction. Now with that cleared, let me talk about the uses of open interest data. Now there are a few uses of open interest data that you should be aware of. The first one is that it helps to identify the potential supports and resistance levels in the market. Further, it also helps to determine the direction of a trend and the sentiment of the market. Now let us first discuss on how to identify the support and resistance levels using open interest data. So in the option chain, you have to find the column on both sides which are having the highest open interest. That is on the call side and put side, you have to find the column with the highest open interest. Then you have to note the corresponding change in open interest also. Now, on the put side, the strike which has the highest open interest number and also having a positive change in open interest can act as a support level. This is because we assume that the put contracts are being sold by the big institutions with the view that the price will not fall below a specific price level or strike price. And most often, these institutions are right, and there is a high chance that the strike level will not be crossed. And a positive change in OI implies that put writers are selling extensively because they feel that the strong will not fall below the respective strike level. Now, on the contrary, if there would have been a negative change in OI, it implies that the put writers are squaring off their positions because they feel that the stock will fall below the respective strike level. Now, when it comes to the call side, the strike which has the biggest open interest number and a positive change in open interest can act as a resistance level. Similar to the previous case, here also we will assume that the open interest is created by the sellers of the call option and they have the view that the price will not move above a particular strike level which will resist the prices. Now, most often they are right and there is a high probability that the level will not be crossed. On top of that, a positive change in open interest implies that the call writers are selling extensively because they feel that the stock will not rise above the respective resistance level. Now, on the opposite, if there would have been a negative change in OI, it would imply that the call writers are squaring up their open positions because they feel that the stock will rise above the respective strike level. Now, it is easier to visualize the support and resistances using open interest with the option chain provided by Sensible rather than the NSE side. Because in NSE website, you have to crunch the numbers more to come to a conclusion about the resistance and support levels. But with Sensible, you can visually see the probable resistance and support level as they are highlighted properly with suitable colors. So you can make use of it if you want. Now we will study what a particular strike price is showing us. A strike price can reveal any of the following. It can be a long build-up, a long unwinding or long liquidation, a short build-up or short covering. Now let us understand what each of this means. If the price is rising and the open interest is also rising, this signals a long build-up. Now, if the price and OI are both rising, it means that new contracts are being added which are dominated by the longs, and that is why the price is rising with every new contract addition. A long build-up on a call option depicts that market participants are ready for bullish action on the index or instrument, whereas a long build-up on a put side depicts that the market participants are ready for bearish action on the index or instrument. So for the call side, the long build-up is viewed as a positive event, while for a put side, it is viewed as a negative event. In the second case, the price is falling and the open interest is falling. It means that the fall in price is due to long liquidation. It is also called as long unwinding. Now notice why the open interest is falling. The reason why the open interest is falling is that the positions are being squared off and the number of open contracts in the market is reducing. But since the price is falling with it, it means that either the long positions are being squared off or new short positions are dominating the transaction. Now think about it. How will long positions be squared off? The simple answer, they will square off by selling. And this is exactly why the prices are falling in this case. Now the prices are not falling because of the new short positions that are being created. The reason being the open interest is also falling. So the real reason for the price fall is because the longs are squaring off their positions. It can be a trap for the unaware traders, and they can be led into thinking that new short positions are being created, but this is not true. Now the long liquidation or unwinding on call options depicts that the market participants are losing hope in the bullish action of an index or instrument, and this may signify a start of a bearish trend, whereas a long unwinding on the put side depicts that the market participants who were bearish on the instrument or index are now witnessing a loss of steam on the bear side, and this may be considered as an inception of a new bullish trend. So for the call side, long unwinding is viewed as a negative event, while for the put side it is a positive event. Now in the third case, if the prices are falling but the open interest is rising, this is called as a short buildup. So if the prices are falling and the open interest is rising, it straight away means that the shorts are dominating the longs. Since the open interest is rising, it means that new contracts are being added. But since the price is also falling, it means that the new contracts which are being added are dominated by shorts and not the longs. So a short buildup on call side depicts that the market participants are writing the calls on a particular strike price, which would act as an immediate resistance when moving ahead. Whereas a short buildup on the put side depicts that the market participants are writing puts on a particular strike price, which would act as an immediate support level for the current scenario. So for the call side, the short buildup is viewed as a negative event, while for the put side, it is viewed as a positive event. Lastly, if the price is rising but the open interest is falling, this is called as short covering. Now, if the price is rising but the open interest is falling, it means that the rise in the price is due to short covering and not new long positions being created. Now, notice why the open interest is falling. It is falling because existing positions are being squared off and the number of open contracts in the markets are reducing. But since the price is rising with it, it means that the short positions are squaring off in the transaction. Now, how will short positions be squared off? Simple answer, they will square off by buying. Now that explains why the prices are rising. So the price is not rising because the longs are dominating or new long positions are being created. Instead, it is rising because the short positions are dominating the squaring off process. So it can act as a trap for those unaware traders who can be led into believing that new long positions are being created, but this is not true. Now, short covering on the call side can signify that the writers are squaring off their positions and they are considering it as a weakening of resistance, which is actually a good sign for the index or instrument to expect a breakout, whereas short covering on puts signifies that the writers are leaving their positions and considering a weakening of support, which is actually a bad sign for the index or instrument. So for the call side, short covering is a positive event, while for the put side, this is a negative event. Now, we have already discussed in the previous section how the relationship between price and open interest gives us an idea about the sentiment of the market. Now, let us identify the market direction using this concept for call and put options. Now, let us study the call option interest first. So, a rise in the call option price along with a rise in the open interest will indicate that there is a long call buildup, which is a bullish sentiment. Similarly, a fall in the call option price but with a rise in the open interest can indicate a short buildup in the call side, which in turn indicates a bearish sentiment. Now, if there is a rise in the call option prices but a fall in the open interest can be observed, it indicates that there is call unwinding or short covering that is happening. And finally, a fall in the call option prices along with the fall in the open interest indicates a long liquidation or long unwinding in the calls. Now let us discuss the same with put side. A rise in put option price along with a rise in the open interest will indicate a long buildup in the put side, which in turn indicates a bearish sentiment. Further, a fall in the put option price but with a rise in the open interest indicates short buildup in the put side, which further indicates bullishness. The third scenario is where there is a rise in the put option prices but with a fall in the open interest. This is a result of put unwinding or long liquidation on the put side. And finally, a fall in the put option price along with a fall in the open interest, it will indicate a short covering or the possible start of the put buying. Now let us combine both calls and puts and try to make a relation out of them. So if a call option writer is adding the position or increasing the position and a put option writer is exiting their positions or decreasing their positions, this indicates a bearish sentiment. Now, if a put option buyer is adding more positions or increasing their positions and the call option buyers are exiting their positions or squaring off or decreasing their positions, this also signals a bearish sentiment. Now, if a call option writer is exiting his positions, but the put option writers are adding more positions, then this is a bullish sentiment. Finally, if the call option buyers are increasing or adding their positions, and the put buyers are decreasing or exiting their positions, this also indicates bullish sentiment. So these are the important relations that you need to be aware of when you are looking at an option chain. So in Sensible's option chain, you can see other elements like delta, vega, gamma, theta, etc., which are called as option Greeks, which by itself is an extensive topic for discussion. So I'll make a separate video or videos on each of them so that you can improve your option chain analysis skill to master the world of option trading. So make sure you practice reading the open interest data and option chain as a whole so that you will get a knack of how to analyze and interpret the data that has been provided in the option chain. So I hope this video was informative, and if you have learned something new, please do like the video, subscribe to the channel and enable the bell icon so that you don't miss out on any upcoming videos. And I will see you guys in the next video. Till then, see you.